Good morning and welcome back to Almus Market Mornings. There's lots happening in the domestic markets. We are starting with India's inflation, which is 2.25% in October from 1.54% in September. This is, of course, the headline number, and it is also the lowest reading in the current CPI series. And what we will try to assess from this number is whether this provides the central bank more room to cut rates. Moving on, the government also okayed some 25,000 crore for export promotion mission and another 20,000 crore as credit support for eligible exporting MSMEs. This is a welcome news given the tariff-related uncertainties which a lot of firms are facing. Good morning, JK. Lower inflation, but what do the details tell us? Is there actually some room for some more rate cuts?
Yeah, good morning, Swaraj. Yes, first of all, this is the lowest inflation rate I have seen myself. Anybody would have seen ever since the series was tracked at 0.25%, and most of the help came from the food prices. Vegetable prices fell by about 27% during the month. These are all year-on-year numbers compared to the previous same month in the previous year. Overall food inflation fell by 5%. There was a fall in the pulses, cereals, fruits, oil, etc., all leading to lower headline number. Improved supply conditions also, the monsoon, better harvest, supply chain bottlenecks being eased, all these things, apart from the large base effects. So the base effect is that, the same month last year would have been much higher. So in comparison, the prices are seeing a much lower rate. So that's something that policymakers will take note of. Apart from these factors, there was also the GST rate cut factor that could have also had the prices being suppressed. Now, coming to the fact whether there will be a rate cut immediately in December, one thing of note is the core inflation still remains at 4.4%, same as last month. That should not be ignored. Headline is also helped by a lot of base effect, favorable base effect. Another important factor is that the Q2 GDP number, which is due later this month, is expected to show 7% plus. So when the growth is so robust, how will the RBI justify another rate cut? Although the situation is that there is a space for a rate cut, but there may not be a need for it. So there can be probably a debate between having one cut in December or in February, depending on how the inflation progresses going forward. And perhaps as per some estimates, even the year-on-year inflation, which is projected at 2.6% by RBI in their last monetary policy, can be revised down. So with at the same time, the mandated band of inflation to be maintained by RBI is between 2 and 6%. If it continues to remain at below 2%, there's some action that needs to be taken as well. Yes, as you mentioned, there was a good news for exporters. $5 billion plus dollar of package to support the exporters affected by the US tariff of 50%. So that is a big relief, no doubt. There is there is an export promotion outlay, and there is also the credit guarantee scheme being extended. The remission schemes have also been extended till March 2026. Now, for the rupee, of course, these are not immediate influencer for moving because it continues to hover in tight ranges. Again, there is no much inflow that is taking care of the demand. So we are seeing offers from central bank keeping the things quiet as of now. We do have some factors coming up that can influence the rupee movement. The host of data that will be released now that the US economy government shutdown has been ended, and also the trade deal, which is somewhere in the month or coming month it can be announced, and also the actual results of the state assembly polls tomorrow. All of them can be a potential market mover. So also as per indications of many surveys, all of them can be negative for the dollar. However, for the rupee, flows still remain the most significant factor to consider. Also, there was focus on two countries yesterday. One is Japan. Okay, Japan, this prime minister actually has, given some sort of a green signal to keep the yen weak. In other words, that's how I read it, because she says Japan has not emerged from deflation. She wants to ensure that inflation is driven by wage gains, and that is not so currently. Even effectively, she's saying not to raise rate, and they are also looking out for, or rather planning, much larger fiscal package this year to support the economy. All this means, more yen printing and more supply of the currency, which could lead to, continued, uh, carry trade by selling the cheaper yen and buying higher yielding assets. And who knows, this can even help the Indian asset markets, because we have particularly the bonds. Now that even inflation considering at 2.5%, we have a very high real interest rate compared to most other countries, and that can be a attraction for the yen carry trades as well. 155 remains a line in the sand for the Bank of Japan. Right now, we are hearing some protest voices from the officials about one-sided currency moves, but I think the real intervention can come only above 158. So long as the market is moving in an orderly fashion, I don't think there will be an intervention. Secondly, if the dollar itself moves higher for any reason, for year-end factor, or even for any positive development from the US, then the up move in the dollar yen will not be protested. The other country in focus was UK, where there's a growing political challenge to the Prime Minister Starmer. Although that is still in a formative stage, not fully crystallized, factors leading, or there is a falling public support. His personal approval ratings has fallen substantially. Polls also suggest that the party could lose substantial ground in the next election, although that is still quite some way away. There are some senior alternative names are also being seen as potential candidates to take over from Starmer. This is a developing story. But my view is that, of course, we have seen political upheavals in France and then also in Japan. After the election, there was a kind of a stalemate, but eventually politicians do come to some sort of understanding, and these things are sorted out. So I don't see this as a big challenge, but right now pound is somewhat depressed, and its weakness is seen more against the euro than against the dollar. Dollar itself has been weak, so pound to dollar has been quite steady above 1.31 as well. So finally, the much awaited government opening in US is on the cards, because the House of Representatives also voted in yesterday's meeting to end the longest government shutdown of the country's history, and it was passed by a comfortable majority. The 43-day-old shutdown now ends, and we'll now start to get a flood of economic releases in the coming days. Most important will be the inflation number and also the employment numbers for September as well as October. So market will be in a sort of bind. They will wait for all the releases to be over before they take a definite direction. Of course, there will be some bias for a weaker dollar or a softer number, because the shutdown is not going to would not have had a positive. It is definitely, if anything, it would have had only a negative impact. Therefore, it will be some sort of a negative bias with which the dollar will be moving until all the releases are over. So, looking ahead to a lot of numbers from the US, which has been missing for quite some time, and of course, the trade numbers from India this week also will be looked at too. Thank you.
Thank you, JK. On the global markets, we are looking for, now that the government shutdown has ended, we will be looking for the data that will be released quite soon. JK, if I'm sure, the White House, I think, has commented that maybe the CPI and the unemployment rate may not be released for the month of October. I think that's what they have recently been saying.
Okay.
Yeah, if I'm not wrong, it's because these
The
were
collection.
yeah, because they were not there. The shutdown during the
Mm,
shutdown, they were not able to do the surveys.
mm,
So
okay.
that's something that might possibly be there, but there will be a whole host of other data that will be released. Bias is on the negative side for the dollar because of that. Sterling remains depressed due to the political and fiscal challenges over there. And domestically, of course, we have had a whole host of developments right from inflation. Now, JK put it quite well. While there is a space for RBI to cut rates, it may not be actually needed uh, because core is still elevated, growth expectations are robust, and headline is more volatile due to the food prices. So there is space, but it is actually not needed for a rate cut. And of course, the various packages that has been announced by the government to support the trade sector, which has been hit by the tariffs. That's it from us, Vivek. Thanks for listening. We'll catch up tomorrow with a fresh round of updates.